Welcome to this explainer. Today, we're going to break down the exact mechanics of high-quality order blocks and totally elevate your technical analysis. Look, if you've spent any time at all staring at price action, you know order blocks are these incredibly interesting zones to execute trades. But let's be real, they can also be incredibly frustrating if you don't know exactly what you're looking for. So today, we're bringing science, structure, and hard data to your charts. It's the million-dollar question, right? Why do some order blocks work flawlessly, launching the price exactly how you predicted, while others get completely ignored and just blow right through your stop loss? Well, to give you the exact data-driven answer, we aren't just relying on theory today. We actually analyzed a rigorous 100-trade backtest across multiple market conditions to find out the precise characteristics of high-probability setups, the ones the market absolutely respects. So here is our roadmap for today. 1. The order block basics. 2. The 100-trade backtest. 3. Hunting for liquidity. 4. Volatility, trend, and freshness. And finally, 5. Execution and confirmations. Let's get right into it.
Starting off with Section 1, the order block basics, building the foundation.
Basically, we consider the last candle that created an inefficiency as our order block zone. Now, inefficiency is the absolute mandatory first clue that major, big money decisions were made during a specific candle. It happens when drastic, forceful market movements create clear, visible gaps between the shadows or wicks of the candlesticks. That sheer, undeniable momentum, that's exactly what we want to capitalize on. But to filter out all the market noise, we have 3 very strict rules that every single valid order block absolutely must pass before we even think about it for a setup. First, as we just saw, it has to create clear inefficiency. Second, that move has to lead to a break of structure or a change of character. This is basically the market telling us if it intends to continue its trend or reverse entirely. And third, it must remain unmitigated, meaning order blocks are one-time use only. We are only looking for opportunities the very first time the price taps back into that zone. Moving right along to Section 2, the 100-trade backtest, the experiment. We tested this exact setup 100 times on the euro/dollar 1-hour chart using Trader Edge software. We tracked a hypothetical $10,000 account, risking just 2% per trade. Now, breaking down those 100 setups, the results might actually surprise you. 28 of them were completely canceled because they just never triggered. And of the trades that actually did execute, 41 ended up being losing trades, while only 31 hit our profit target. Think about that. Our losses actually outweighed our wins. So the crucial takeaway here is that this rigorous backtest yielded only a 43% win rate. Just let that sink in for a second. This completely shatters that persistent retail trading myth that you need to be right 80 or 90% of the time to be successful. In reality, a sub 50% win rate is incredibly common, even when you're using a fantastic strategy. And this brilliantly illustrates our baseline profitability. Because our strategy explicitly targets 2 times our stop-loss risk for profits, that humble 43% win rate still skyrocketed the initial $10,000 account by 47%. Even with a maximum drawdown of only 10%, the math just works in your favor when your risk to reward is strictly managed.
All right, Section 3, hunting for liquidity and filtering setups.
To find the absolute best setups, we score them based on repetitive market patterns. We actually deduct a point, giving it a -1, if we see a valid order block with a gap and then another valid order block directly beneath it. Why? Well, because there is a very high probability the market will break that first block just to grab retail stop losses, acting as a trap, before tapping the deeper block. On the flip side, if an order block is created by a move that just swept liquidity from equal highs or equal lows, we reward it with a +1. That sweep acts like high-octane fuel for future movements. But even with these incredible filters, you have to keep this idea in mind. Every time you encounter a losing trade, it does not necessarily mean that there was a certain error in your analysis. Look, we can never perfectly control the market. No strategy works 100% of the time, and that's totally okay. The real secret is to take your losses in stride, trust the backtested math, and aggressively stick to your structured rules. That brings us to Section 4, volatility, trend, and freshness. Let's look at market conditions. An order block is really only as good as the market context it sits inside of, and the backtest data made it super clear that timing and conditions are everything. You should aim to trade during mid-week days, avoiding that low liquidity we often see on the first and last days of the trading week. You also need to align your setups with highly volatile sessions, specifically London and New York. And finally, avoid pairs with high spreads. The market frequently reacts to these order blocks within a single pip.
A high spread will cause you to miss winning entries or, even worse, trigger a false stop loss when the true market price never actually touched it.
You should also highly prioritize freshly printed order blocks in a clearly trending market. In a strong trend, fresh blocks are heavily respected as the dominant momentum continues pushing forward. Ranging scenarios, on the other hand, they are a constant, unpredictable fight between supply and demand. If you spend too much time waiting for an old block to be tapped in a ranging market, it often leads to a painful loss because the underlying market context has simply churned into something entirely different.
And finally, Section 5, Execution and Confirmations, the final trigger.
To really protect ourselves from unnecessary losses, we use a step-by-step confirmation process that acts as your ultimate shield. Once you spot a valid block on your higher time frame, say the 1-hour chart, you don't just blindly place an order. Instead, you zoom in 2 timeframes lower, down to the 5-minute chart. Then you wait patiently for price action to show its hand by creating a lower timeframe change of character. This proves the short-term pullback has officially reversed in your favor before you risk a single cent of your capital.
Once that lower time frame change of character happens, we typically see one of 2 patterns to enter. Entry strategy 1 is what we call the new inefficiency. If the change of character creates a brand new inefficiency, gap, and order block on that lower time frame, we enter just a spread size above it. As the trade moves in our favor, we systematically trail our stop loss right under the new higher lows. This is an awesome way to ride massive risk-to-reward movements all the way to the next major supply zone without all the stress.
But what if that lower time frame reversal doesn't leave a clean gap behind? That is when we pivot to entry strategy 2, the Fibonacci retracement. When there's no inefficiency, we draw our fib tool from the very start of the change of character move to the very end of it. We then place our buy order right in the middle of the 61.8 and 78.6 retracement levels, tucking our stop loss safely a couple of pips below the swing low. It's a great way to confidently catch that pullback.
Ultimately, it all comes back to trusting the structure. The data proves it. You do not need a magical crystal ball to be profitable. With a 43% win rate yielding a massive 47% account growth, my question to you is this: how will you use these optimized, strictly rule-based order block filters to stop chasing unrealistic 90% win rates and start redefining your real trading edge tomorrow? Thanks for tuning into this explainer. Now take these concepts back to your charts and let the data do the heavy lifting.